2019 has been an impressive year for global equity markets. However, this is partly because markets started from a low base in the wake of the major sell-off that struck in the fourth quarter of last year. Investors remain cautious on the outlook for equities amid concerns about global trade tensions and weakening economic growth across many major economies. So what's in store for 2020? Bob Iaccino is the chief strategist at Path Trading and joins us down the line from New York. Bob, good to see you as always. Talk us through what we've been seeing in terms of the global equity picture this year.
Well, I think you hit it right on the head when you mentioned the terror that came through the trading markets from the end of last year. We had a situation in 2018 where we had markets up in the range of 18% that ended up finishing down 6 to 9%, depending on which index or which benchmark you're looking at. So what we saw toward the end of the year in 2019 was much less activity, especially from some of the bigger trading houses. And going back and forth from New York to Chicago, that was a pretty consistent theme for me. So going into 2020, I would expect activity to pick up in a more dramatic way than it normally would.
So do you remain optimistic in terms of the outlook for equity markets in 2020 broadly?
That's a great question. I mean, and that's the only question, right? I do, but I do expect a pullback, and I expect that pullback to be major. There's several factors going into 2020, not the least of which being the U.S. election, that could potentially hit markets and hit markets pretty hard. The outlook of or the outcome, I should say, of the U.S. election is going to be down the road and could have the same effect that we saw in 2018, potentially. But I believe there's going to be a pullback, and I believe that pullback brings at least U.S. equities back into a fair price level, which I think they're a little expensive toward the end of 2019.
It's interesting what you're saying about the presidential cycle, though, because kind of the textbook would say in the year running up to an election, you'd expect to see a tailwind for markets.
Yeah, and I would expect that for most of the year. I think that, let's put it this way, the current president has been positive for the markets. Whether he's been positive in any other way, I think can be argued from both sides, but he's been positive for the equity markets. And you mentioned the trade tensions that have built up. It wasn't just the U.S. against one country. There were several countries. We saw drops in global trade for the first time in 2 decades at the end of 2019. So you're going to want to see that pick back up. Global trade has been the driver. So it could go either way, depending on how the election turns out. It isn't necessarily that President Trump gets reelected, the market continues to rally, which I think will be the story for at least the first 2 quarters of the year. But as I mentioned, I think we've got an 8 to 10% pullback coming, but then I think the bull market can continue. We talk about this having been, so far at least, the longest recovery ever in U.S. history. But the GDP is only up a little over 26% at the end of 2019. That's pretty average. So while we've had a long recovery, the level of the recovery, the strength of the recovery has been average at best.
So you mentioned the trade war. Do you see that continuing to be a key theme for markets throughout most of next year? And how do you see that weighing on markets?
Well, it's the theme. Toward the end of 2019, to take, say, the last quarter, every rally we saw was on positive trade rhetoric, either between the U.S. and China, the U.S. and the EU, even the U.S. and the U.K. When the rhetoric was positive, and you can throw Japan in there, you can throw USMCA in there, our market rallied. The only rally we saw that wasn't trade related was in that November payrolls number that we got for the month of October. The December for November. That was the first rally we saw that wasn't trade related. And I don't see that changing going forward because, again, it's not just U.S.-China. It's U.S.-EU, specifically Germany. It's U.S.-Japan. It's U.S.-UK. And it's U.S.-Mexico-Canada as well, not only with the USMCA, but how does that actually play out?
So what about monetary policy? Because 2019 has really been the year where we've seen a shift from policy normalization to policy accommodation. I imagine you expect further accommodation in the year ahead. Do you think that's likely to provide a tailwind to market, or are we at a point now where we're getting a little bit of the fatigue?
It's a much lighter tailwind than it's been in the past. And take the U.S. out of it, I think Christine Lagarde has a very heavy weight to lift. The global central banks coming into the end of 2019 spoke more of fiscal policy than I ever heard them speak of. Generally, it was the the habit of central bankers to not speak on fiscal policy at all. And I think there was a concerted effort after Jackson Hole, specifically in 2019, for central bankers to start speaking to the governments and basically saying, if we're translating, look, we can't do much more than we've already done. I mean, you look at the EU having had negative interest rates for a good part of 2019, how much more negative can they go? And if the US reaches into negative interest rates, that now starts to break the banking system. It's not set up that way. When the global currency, the global reserve currency has negative interest rates, there's a lot of things that can break. So I think it's a secondary story behind trade simply because there just isn't that much more they can do.
And where do you stand on the outlook for developed markets versus emerging market equities in 2020?
Oddly enough, I think emerging markets could outperform. If the global growth story turns around, money starts flowing back into emerging markets pretty quickly. And in the same way that EM can fall quickly, it can rally quickly. So I think it might be an area of outperformance. But as I mentioned at the end of 2019 many times in many different interviews, everything we've been doing from the fourth quarter of 2019, and it will continue in at least the first quarter of 2020, is going to be hedged. We're going to have very few naked positions where we're just looking for upside.
And what about corporate earnings? What's your view on the performance there next year?
Trade. It's completely trade dependent. We could see single-digit growth in the U.S. I think it'll be less than what people are talking about going forward. But trade it's a luxury cruise liner. It's not a speedboat. It's taken a long time for trade to weigh down GDP globally, and I would argue in the U.S. as well going forward. It's not going to spin on a dime either. And there have been companies that have moved to adjust supply chains, and they're not just going to move back. So I think it's going to take a long time for that ship to turn because, again, it's not a speedboat.
Bob, thank you very much for your time as always.
Happy to be here.
That was Bob Iaccino, Chief Strategist at Path Trading. I'm Victoria Scholar, and thanks for watching IGTV.